In this presentation, we will record investments into our personal account within QuickBooks using one account in order to summarize our investments. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. You can open the open windows by going to the view drop down and selecting the open windows list. We're now going to go to the balance sheet and take a look at what we have so far because we will be adding investments to it. So we will go to the reports drop down to the company and financial, and we want to take a look at the balance sheet standard. And we're going to change the dates up top in the customized reports section, dates being 01/01/20 to 12/31/20. That is January 1st, 2020 to December 31st, 2020. And okay. Here's what we have so far. We've been entering the data, but we've been entering the data from the bank statement, and that will typically give us a good information for the income statement, profit and loss, but not so much for the balance sheet in terms of anything happening prior to that point in time. So we're now going to take a look at a couple things that could be more balance sheet related if we wanted to start to shore up the balance sheet so we can look at our balance sheet and have a better idea of where we stand at a particular point in time. And therefore, one of those issues is going to be investments. So we might have investments. We might have a 401k plan. We might have other stocks and bonds that we would want to have on the balance sheet that we had purchased prior to us starting the QuickBooks file. Okay, so how do we get that on the records? Because it wouldn't be on the bank statement unless we were actually investing at that point in time. Then it would be on the bank statement. Otherwise, it's already there. And it's going to be going up and down in value. How do we deal with that? First, I want to note that the financial statements here are not, or QuickBooks is not a type of program to track stocks and bonds and run reports basically on just the tracking of the day trading type of software. That's not what you want to use QuickBooks for. It's just, but what you can do is put the information into QuickBooks so that you can get a good idea of your overall balance. So we're going to track the ups and downs and know when we want to buy and sell with other types of software, maybe just putting it into or using the software with our investment company or putting that information into Excel. We put it into QuickBooks so we can see it in the big picture overall with our other assets to see what our net worth is in general. So that's going to be our goal. Keeping that in mind, we have to think about how much detail do we want to put into the QuickBooks file. So a couple different methods here. This is going to be our mock income statement or our statement for investments. So we could think of this as like a E-Trade or something that we put money in online, like a Vanguard account or an E-Trade account or some type of investment company that we put money into. We would get statements that we're going to say monthly or possibly quarterly, and we can update then our QuickBooks file as we get those statements. We started entering the data into our system as of January. So we started entering our data into the system as of January. We might want to then get our statement right before that January, this December, before we started entering the data, and then we can enter our beginning balances once again right before the year that we start entering our data into the system. So we've entered 2 months of data. We can go back in time then and say, okay, here's our mutual funds, here's our bonds, here's our retirement accounts, and let's go ahead and put this back into our system as of when we started recording stuff into QuickBooks. So we've had these investments prior to that point. We're going to go back and put this information into our system. Now we could have multiple types of places that we invest in, or we may have one place with multiple types of accounts. For example, we might have, and this isn't investment advice, but I'm just breaking out some typical types of investments. We might have mutual funds. I have index funds, giving index funds here. So high value index fund, Pacific stock index fund, mid cap index fund at cost, market value, and then typically a gain or a loss. This is usually what we see on our statement. This is what we bought it for. This is the market value. This is the gain or loss. The market value and the gain or loss will change from statement to statement, and of course the cost will remain much the same unless we buy more of the stock. And then we might break that out as well between our bonds funds. We might want a different account for the bonds funds. And then we might have retirement accounts, which is just basically the same thing. I mean, any of these types of investments could be under the retirement option as well. The retirement option just means that we put it under a special window for retirement. So that we could probably put it there so that we get a tax saving at the point in time that we put it into that umbrella. So all that means is that we can't take this stuff out as readily as we can with these items. These are fairly liquid types of investments. We can take it out of a normal mutual fund without much problem. But if it's under an IRA or a 401k, then if we take the money out, we're going to get penalized. Therefore, we don't want to take this money out, and it's not really accessible to us easily without getting penalized until a later point in time. Whereas this is more accessible. So what we're going to do here is put this into our system a couple different ways. And we'll start off by just putting it in with 3 summary accounts. We'll put in our mutual funds and just summarize all the mutual funds. We'll put in our bonds and just summarize all them. In other words, we're not going to put the detail for each stock, but go by the idea that we will go back to our stock forms here and to our investment company to track the performance of the stock for trading purposes. And for our purposes here, record the summary of it so we can get just a value of where we stand at a given point in time, thereby making it easier for us to update this information and still be able to track it in another format. We could also track it in Excel or some other formats outside of the system. So that's where we will start. We're going to enter it at cost. Now, you don't have to enter it at cost. You could track it at market value, but this is what we'll start with. We'll start with just basically entering it at cost. And that's kind of the most conservative way to put it into the system, because we haven't realized any of the gains or losses yet. And typically, hopefully, there'll be gains, but they're not really realized till we sell it. So if we keep it at cost, that's kind of the most conservative format. So that's where we'll start at least. So we'll go back over here to QuickBooks. And the question is, how are we going to enter this information into QuickBooks now? We can't really use the check register because we didn't, there's no cash. We put the money in there before the point in time we started doing this. And so we don't want to have to go back in time and figure out when we actually invested in the company to do this. So what we're going to do is use a different register. So we're going to make a new account and then we'll add to the register. So we want an account up here, and we're just going to call it mutual funds or something like that. Investments, mutual funds, investment bonds, and then we'll have investments for the IRA. So that's what we'll take a look at. We'll do that by going to lists up top, chart of accounts, lists and chart of accounts. We're going to go down to the account drop down, which actually drops up or rises up when you click on the drop down, and we're going to go into the new account, and we want this to be, we're going to start off with an other current asset type of account. Other current asset, and continue. And then I'm just going to name this current asset. It's going to have some type of investment type name. We'll just call it investment mutual funds for now. Investment mutual funds. So that's where we'll start, and we'll just save and close that one. And so the next one we're going to have, there's going to be 3 accounts just for our 3 groups and categories. Is we're going to have another account, new account, and we'll make that the same. It's going to be an other current asset, and continue. And then let's make this an investment for bonds. So we'll say investment and then bonds funds. We'll save that one. That's the one we want. And then we've got another one, and the next one needs to be, I want to make it like an IRA. And notice we already have this E-Trade IRA that we put money into. So we can't keep that one. Remember how we set that up? I right click and edit that one. Let's edit the account. And if we want to keep the same kind of system we have, we might keep it at E-Trade or just call it investments. And so I'll put it into investment IRA. Now we may want to put it, if we had more than different places like E-Trade and other places, then that we were investing in different investment platforms, companies, then we may want to have, of course, the different types of platforms and companies so that we can track these by statement. We want to be able to group them by statement because that's going to be the easiest way for us to just update this periodically. Note that this is an other current asset, not a current asset. And that's because it's going to be in a little bit lower down on the income statement because it's not as liquid. We can't take this money out as readily. So we're going to say save and close. And here we have that. So two current assets and then the other current asset. Now we're going to add the detail to it. So we're going to go in here and I'm just going to add the cost. So for the first one, the mutual funds, I'm just going to take the net or all of it at cost. This is what we paid for it because we haven't realized the gain or loss. And then we're going to do the same for the bonds, which only has one account. If it had more than one, we would group them together under this method all in one. So now we're just going to break them out by groupings of funds, so instead of listing each individual fund, so that we can save time and be able to track and update this information more easily, hopefully at least quarterly or monthly. So we'll go back over here. Now we're just going to double click on it, double click on the investment, and we get a similar register that we had for the check register. I'm going to enter this data as of 12/31/19. That's December 31st, 2019, the time period before the time period we started entering data. This is for the bond fund. Now you see, or for the investment, and it has increase and decrease. And we're going to increase it by the amount of the 18,000. So the 18,000. So notice we're not giving the detail. We're just entering on the 18,000 and going to the statement if we want more detail. And then where does the other side go? We can't really put it to an income statement account because if we do, well, we could now because we put it before. If we put it to income, it wouldn't hurt because we put this in before the date that we started working. But you could do this in the current year and whatnot. We don't really want to mess up income. And the way you do that is you put it straight to equity. So I'm just going to put this straight to the equity account. So we'll hit the drop down and we'll go to equity. So that won't affect net income. We'll just put it to equity, which is kind of like the net value of the company. And then we'll say enter. Yes. And it's going to say, I'm paraphrasing, it's going to retained earnings account, a type of retained earnings account. That's okay. And there we have it. So we're going to close that out. And then if we go to the balance sheet, we'll see we've got this investment now, 18 on the books. And the other side went to the equity, which is what we would expect on the balance sheet, no effect on the income statement or profit and loss. And it's on there as one group sum. It's on there as a, let's make this a little bit larger, fonts. And we're going to change it to 11. Okay, yes, okay. So there it is, there's the 18,000. And so now, that's in at cost. So now we'll do the same thing, chart of accounts, for the bonds by just double clicking on the bonds. And we're going to say this is as of 12/31/19, same deal. It's going up by the amount of the bonds for 28, or I'm sorry, the bonds are for 3,000. 3,000 on the bonds. And again, we're going to take it to an equity account. So even if you didn't do this would work even if we did it in the middle of the year. You don't have to worry about it if you take it to equity, because it's not going to affect the income statement or mess your income statement up. So we'll take it here and go to equity and okay. Whoop, it won't, and then I have to say yes. And then close that out. And then let's do this one more time to the IRA. So we're going to put the IRA separate because it's not as liquid. That's why we're breaking the IRA out, not grouping this all together. We could, of course, just put the whole 15, by the way. That's another method we could use. But I think it might be nice just to break out the mutual funds versus maybe the bonds versus the stock, the equity versus the stock, and then the retirement. Probably a good idea because this is long term. So you want to be able to see on the balance sheet the types of stuff that you can take out and use if you had to, if you want to, if you're saving for something, and the types of stuff that you can't really take out unless you're going to be penalized to do so. And so we'll see how that works with this. Okay, so then we're going to say then that I'm going to close this back out because, oh yeah, let's go back into it. Okay, so now we're going to have an increase. Now the 1,000 was put in place later after this time period, so that's fine. And we're going to put the beginning balance, which was 15,000. So we're going to say 15,000 increase, 15,000 tab. And the other side, once again, is going to be going to equity and the owner's equity and enter. So that's what we want. Okay. And there we have it. Now, if we go back to the balance sheet, then what we have, and is the 18 in the investment, the 3,000 in the investment, and those are current assets. So we have them grouped up into the current assets section. And then in the other assets, the stuff that's more long-term that we can't really take out, we have the IRA that's included in there, 16, because if I double click on it, it was the 15 that we put in there, and then the 1,000 that we put more in during the 2-month time period, January. We put more money in January. So we'll close that out. And so that's one way we can start to represent this. There's not going to be too much activity here as we go from month to month entering data into the system, especially since we're on a cost basis here. But whenever we go back and we look at the balance sheet and say, okay, how much money, where do we stand on the total asset side, on my net worth equity side, then we of course would like to have that in place when we're considering those questions. Now we have it currently in there at cost. So that's, again, the most conservative kind of way. The next way we could do it is obviously put it in there at market value to mark it up. And so we'll look at different methods for us to track the market value, which we might want to see rather than cost. So we might want to see both cost and market value. So there's different ways we can represent and do that. For more accounting information and accounting courses, visit our website at accountinginstruction.info.